I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 16th, 2024. If you're an investor, and if you are invested in the market and you have been invested this year, you believe this is the thing to do, whatever methodology you use, you have been correct. The market has gone up and up and up. There have been a few minor corrections, but they were just minor corrections. So that is the approach for 2024. It appears that that is a valid approach going forward in the short run. In the long run, I don't believe that, but you need to have a strategy for dealing with a down market when one comes, not if it comes. And when I say a down market, I mean a serious down market, more of a collapse. And so I don't want to beat the drums on that and say that's going to happen this time or that time or within the next year. It may, but it doesn't appear to be right now. But when it does happen, people will be, quote, running for the exits. And the sooner you can have your defensive strategy in place when that happens, the better. Very hard to do, though. I mean, I can sit here and say that, but it's hard for people to come up with something. I've spent literally thousands of hours doing research trying to figure that out, and it is not an easy thing to do. And okay, so I want to get into the dashboards to show you what's going on with the market. Now, this is an interesting chart or an interesting picture showing to the right, I've got 6 major equity indexes. This is the 4 U.S. equity indexes, the Dow, the S&P, NASDAQ, and Russell 2000 small cap index. And at the very bottom, I have the TLT, which is the long-term government bond ETF. And these dots to the right, the green dot shows that they are that particular index, you know, going top to bottom, that index is above its 20, 50, 100, 200-day moving average, or if it's green, or if it's red, it's below, which indicates probably, you know, it's in bear territory if it's green, it's bullish if it's green, or bear territory if it's red, bullish if it's green. And so anyway, it's interesting that all 6, 4 U.S. and 2 international indexes are all positive for all periods of time, or all moving averages. And it's also interesting to that, I don't think I've seen this particular pattern before. It's interesting that the bonds, the long-term government bond ETF, TLT, is below all 4 of its moving averages. So all above on the equities, all below on bonds. So pretty interesting. In the yellow box, there is, you know, it's mixed. So you've got some of the ETFs that are positive for the last week in the yellow box, and then some are negative. And then the pink box, they are all positive except for bonds, which are negative by 5% for the year. The equities, the top S&P 500, NASDAQ, S&P 500, NASDAQ 100, emerging markets, Dow Industrials, Russell 2000, and the developed markets. So really going all the way from 21% gain for the year all the way down to 9%. But all positive for the year. When we look at the sectors for the year, we see those are in the pink box. They go all the way from financials up 23%, industrials up 21%, and technology up 19%, etc. And they go all the way down. And the ones that are in single digits are consumer discretionary, real estate, and retail. It's an interesting mixture of the ones that tend to be on top and the ones that tend to be on bottom. It kind of got mixed up quite a bit here. And then for the week, there are 8 out of the 11 that are positive and 4 that are negative. The most positive ones are industrials and technology, and the most negative was retail. On the dots, there are 39 out of 44 that are green, that means positive, above their moving averages, and there are 5 that are negative. And so it's an interesting picture. So the ones most negative was the consumer staples, which was below its 20 and 50 period moving averages. Okay, next is a chart, a line chart, a weekly line chart of the S&P 500 for the last 30 months. Now, I stretch this out from 24 to 30, just so you can see the magnitude of the trajectory. With my black arrow, I'm pointing from the bottom to the top. You can see at the very end of the chart that the S&P 500, represented by the ETF SPY, not only went up, it had a trajectory going even further up at the very end of it. So this is, if you think in terms of reverting to the mean, or you think in terms of contrarian, you would say, this is a time to short the S&P. Okay, but if you're a trend following person, you would say the trend is up, and you go with the trend. It will still go up and down some, but it is trending up. When I put that same 30-month period, when I put it on a candlestick chart, you can see the number of weeks measured by the candlestick, which is a hollow candlestick, where it goes up, and the number of weeks where it goes down, which is represented by a red one. So most of the weeks during this period of time are positive. They're hollow candlesticks. This is a relative strength chart. So this is the NASDAQ 100 compared to the S&P 500. Now, the 100 stocks that are in the NASDAQ 100 are probably all or nearly all in the S&P 500. But the S&P 500 also includes value stocks. There's another 400 stocks in the S&P 500. And so when you take the growth stocks, NASDAQ 100, divided by the S&P 500, it's still over this period of time, over about, 21 months, is moving in a positive direction. But as you look at the very end of it, for the last 3 months or so, it has moved down, which favors the S&P 500 over the growth index, NASDAQ 100. So it's a little bit of both. Then when I take the S&P 500 and just break it apart into growth and value, so it's sort of the same thing as the NASDAQ 100 versus the S&P 500, but it's a little different. So when you look at this, you see the same thing. Over this 24-month period of time, it has moved in an upward direction, favoring growth stocks over value. However, during the past 3 months or so, you can see the degree to which that has come down, and it favors more value during the past 3 months. Another relative strength chart showing the S&P 500 compared to the small cap Russell 2000 small cap index. IWM is the ticker symbol for the ETF. You can see again, same pattern, going up, favoring the S&P 500, but there is a drop again during the past 3 months or so, where it is still below where it was at its peak, favoring, in that 3-month period, favors a little bit more on the Russell 2000 small cap index. Bonds, the long-term government bond ETF TLT had a bad week. It went down. You saw that on the previous data. So it went up and now it's coming back down, and it has actually come down at the very far right corner, the lower right corner. It has crossed over or through the 20 period moving average. And for the last couple of weeks, it has been definitely down, 2 or 3 weeks. It's been down, going in a downward direction. I don't know how far it's going to go down. I don't want to, speculate on that. But I would say for several months, maybe the last 12 months, it is positive. But when you look at the shorter term picture, it's either mixed or it's negative. The dollar continued to rally a couple of weeks up, and it has moved up through the 20 period moving average. This is a 3.5-year chart, and so you can see from the beginning to the very end, the value of the dollar is going up. Now, you may say, well, I think the dollar is getting devalued right and left. Okay, you may be right, but on a relative to other currencies, it is actually stronger. So if you're buying things in foreign countries, your dollar goes further. If you're in foreign countries and you're buying things in the U.S., your dollar does not go as far. Gold is continuing to hold up its value. You can see the direction of gold in the last 2 years, very positive. And I think that's because there is risk out there. There is risk below the surface. The S&P 500 has gone up. It's been positive. Generally, most equity markets are positive. But why is gold, which is a defensive asset, why is it going up when other equity indexes or equity assets are going down, or at least risky? This does not look risky. So this is telling a little bit different story. Silver moves all over the map more than gold does. When it goes up nicely, it goes up very nicely, and then it sometimes comes down. So you see this last week, you see that drop at the very far upper right of the chart. It had a down week. But generally speaking, for the last 12 months, October of 23 to October of 24, in the last 12 months, silver has rallied nicely. Bitcoin has continued to pull back. It is not in a deep pullback, but it is going in a downward direction over the past 6 months or so. The volatility index is, for the past 3 or 4 months, has been going up, which signals a higher risk in the market. So when volatility goes up, that means usually equities go down, but that did not happen this time. So I think there are some equities that are going down, or there is fear that some are going to go down. So it's interesting when we see the S&P 500 chart doing so well, and yet the volatility index doesn't seem to reflect that. It should be coming way down, but here it is up above 20, and you would think it would be down around 12 or something. So something is going on where people are fearing, it's called a fear index actually, where they are fearing that things are moving in the wrong direction. I put my red marker there at 24. When this pushes up above 24, usually, not always, but usually it means look out. Risk is getting at a higher elevation, something to be concerned about. But we're not there yet. Asbury Research, they have put their Asbury 6, there are 6 metrics where they measure risk in the market. I think this is the 3rd week in a row where it's been 5 out of 6 have been positive. So, and of course 1 negative. They compare, Asbury compares assets. They compare one to another, and these are to show where the strength is. For example, I look at all three going in the last three columns going from left to right, the last week, the last month, the last quarter. Stocks are favored over bonds. High beta favored over low beta or low volatility. U.S. markets are favored over developed markets. Usually that means Europe and Japan. And high yield bonds are favored over corporate high quality bonds, and short-term bonds are favored over long-term bonds. So when you compare the equities, the equity indexes, and this would be the S&P 500 for the U.S., you compare the U.S. to other countries, and there's an ETF for each of the countries that would be their equivalent of the S&P 500. The only one that is better than the U.S. for all three time periods is Peru. Interesting. And the U.S. is favored over many of them. You can see that for all three time periods. Those include Chile, Brazil, Italy, Germany, Spain, France, UK, the entire Eurozone, Malaysia, Japan, Singapore, South Korea, and India, Thailand, and Australia. So the U.S. is doing better than many of them, but Peru is doing better than the U.S. in all three time periods. I did this to show you, this was a very consistent chart over the past couple of years, almost couple of years, showing how the U.S. is doing versus South Korea. Stronger and stronger and stronger. I could, all of the ones that I've just showed you, many of them are doing better, but this is the chart that has the most consistency to it. Okay, gold and silver. So these are spot prices. So on top of this number, you need to add the markup. So the spot price on gold is $2,651 per 1 ounce of generic, not a silver eagle or not a gold eagle, but generic gold. And that is down 1/10 of 1% from last week. And you saw that at the top of the chart at the very upper right, kind of almost flat. Silver is $31.19. It dropped about $1 per ounce and is down 3% from the previous Friday. This took the gold-silver ratio to 85-1. A monster box of silver is $16,195, and that includes a $1.20 markup over spot, which brings the total to $32.39. The prices vary depending on the retailer you buy them from. So that just gives you an indication as to what you might be paying. As I said earlier, the bulls are in charge of the market. The bears are being beaten pretty badly. When will that change? I don't know. I just say for right now, it looks very bullish, and it seems to continue. And if there's a downtrend, it's not showing yet. Thank you for watching. If you have questions or comments, leave them in the comment section below.